Hey there, everyone. Welcome to another live episode of Be the Boss of Your Money. Is the market about to retest its lows? Is the rally over? Did we just have the full rebound? Is that the end of it? Or is it just a case that reality, economic reality, has finally caught up to the stock market? That's what we're going to talk about, and I want to make a decision by the end of this. So tune in, stick around. Welcome. Let's roll the intro. Okay, everyone, welcome back. We're live. I'm Mitch Goldberg. If we haven't met yet, I am a financial advisor with decades of experience. I own and operate a wealth management firm. It's called Client First Strategy. I greatly appreciate you sticking around, showing up, and watching this. We are talking about business today. We're talking about specifically the stock market, the business of the economy, and there are a number of things, a number of worries going around. I don't think all is lost. If you're a regular viewer of the show, for the last, week and a half, I've been saying, if you are invested in terms of risk, if you are invested over your skis and you're thinking, darn it, I took too much risk and I was really worried, really upset when the market was much lower at the end of this past March, then right now is the time that you should be thinking about taking profits, reallocating, rebalancing, and going a bit more conservative. Yesterday, I said, what are you waiting for, if that's what you're waiting for? Now, in the last couple of days, the Dow is down, 1,200 points? A little more? Okay, between the end of last week and now. So this has been a pretty good size give back. Major averages are down pretty good today. That definitely gets my attention. So what was the deal? Let me see if anybody's out there today. And I'm going to say to you, welcome. And if you have any questions, hit me up in the comments. I would love to answer them. Even if you disagree with me, let me know. Okay? If you're watching this in the replay, I'd like to welcome you as well. You are welcome to ask away as if you're watching the live. I will see the questions. I will look in the comments. I will get back to you. So what the heck happened? Yesterday, the title of the show, every day I give a new title. Yesterday, the stock market is eerily quiet. About 15 minutes after I sent out the promo picture, the Dow dropped about 300 or 400 points right after I sent that out. So it's no longer quiet. Quiet doesn't last, you see. Either we're up or we're down. Rarely are we steady. That certainly has been the pace for this year. If we can say anything about the year 2020, is that we don't have too many boring, flat days. Today is no exception. So what we're going to do first is with perspective. Anyone, can tell you how much the stock market went up or down. You don't actually need anybody to tell you that. You can look that up. But what I want to do is actually give you perspective. So let's do a little share screen. I'm going to get you into the overall averages where we need to be. Share screen. All right. It's tougher to see this screen the way I had it. I don't know why I had it set up this way. But the bottom line is the major averages, if you haven't heard by now, we're down pretty good today. Let's make this a little bigger, and then we're going to see it. So the Dow is down over 500 points, down over 2%. The S&P down 50 points, down almost 2%, and the NASDAQ down a little bit less than 1.6%. So overall, this was a pretty tough day and a stretch from the beginning to see anything positive come out of the day. It's a shame because, late last night, the futures were actually pointing to an up market. Okay. So why did the market go down? The market went down for a couple of basic reasons. And, there is the reasons and there are the real reasons. We had a big rally. 30% plus off the March 23rd lows. We had a big rally. We're going to give some back. Even the NASDAQ actually got into positive territory on the year. And the major averages altogether, none of them are down so much from the close of 2019 that you would think we're in a disastrous economy, which we are in a disastrous economy. Yes, granted, things are off a little bit more from the all-time peaks around mid-February. It's not even irrelevant. I mean, the amount of time that the Dow spent and the major averages spent in record territory was like a day or two. And yet that becomes the standard by which every move in the market is judged. It's the wrong way to go. Market's down to where we were maybe, third quarter last year. Maybe a little better than that. Maybe not as bad. What happened is this: we have a big rally. We're going to give some back. You just need an excuse. I'm fortunate. I had a nice news appearance with a gentleman named Stone Grissom. He's an anchor on iNews 12. And what I said to him last week, was that this is the Janet Jackson market. What have you done for me lately? What have you done for me lately? Man, that just bad music in the 80s, but except for you two. Except for that. So, what have you done for me lately? Because we had news of the economy, of the different states reopening. Most of them are open in some way, shape, or form. Social distancing still in effect. You had positive news from the Gilead drug, remdesivir, an antiviral drug. You had the news app. So it's buying the rumor, selling the news, and the market is saying, great, but all of that news is in the rearview mirror. We need something new. That's why the market asks, what have you done for me lately? That's the real reason why it's down. But let's get into the mechanics. Jerome Powell, Fed chair. We could stop sharing the screen for a minute. You like the picture behind me? The sick. I was looking for something for the sick economy. So I found this picture. I thought it was apropos. We have a sick economy. We have Jerome Powell, who came out today and said he will not go into negative interest rates, but he is willing to look at different programs, quantitative easing. That's buying more types of commercial, more kinds of bonds, commercial paper, short-term corporate bonds, treasury securities, municipal debt. And people wonder, why does the Fed need to do this? Why would the Fed buy bonds? If you don't know, I'm going to tell you once and for all what it means, what this means. It's important that you know. When the U.S. government sells bonds, the bonds are called treasuries. When a corporation sells bonds, debt, corporate bonds, they're called corporate bonds, municipal bonds, et cetera. So if you're a municipality, central government, corporations, they want to borrow, they issue debt. Where does this debt in the form of bonds, fixed income securities, where does it end up? It ends up with you and me. It ends up in our 401k plan, our IRA. It ends up in the exchange traded funds, the bond ETFs or the mutual funds. But think of it this way. ETFs, exchange traded funds and mutual funds, those are for the end user. Your financial consumer of products and services. That's you and me. We buy that stuff. If we're not willing to put money into the bond market, I'm not willing to buy more ETFs or put more money into mutual funds, then the fund managers from these fund companies, whether if it's ETF companies or mutual fund companies or both, because a lot of companies issue both ETFs and mutual funds, like BlackRock, which issues iShares, and Vanguard has their ETFs, and so does Fidelity and others. So if you don't have end buyers like you and me who are willing to put more money into the bond market to give more money to the fund managers so the fund managers can go out and buy more bonds, and same thing with stocks, well, we're not going to get into stocks. That's not what the Fed's buying. So if you look at it like that, if us, the end user, are not willing to put money into these end products, well, then the borrowers, like the corporations, the municipalities and the central government, who are they going to sell all these bonds to? So the Federal Reserve says, we'll buy everything you got, give us everything, and we'll give you the money for it. So companies are able to borrow. The U.S. government is able to borrow. Municipalities, they're able to borrow. and it just keeps the wheels greasy. It keeps them going. Axle grease. Okay, so Powell said he's going to probably have to do some big things. He said he's encouraged by the big things that have been done, like the CARES Act and some other monster stimulus programs and all the things that the Fed has done. And we could see more. We're already seeing, I think, a setup for a showdown in Congress for more stimulus. So the beat goes on. So Powell gave a pretty negative assessment of the U.S. economy. I don't know why people needed Powell to give a negative assessment of the economy. We already knew that. Jerome Powell, who's the chairman of the Federal Reserve. I think it's actually positive if the chairman gives a negative assessment, because he's the one who can make the decision of whether or not we get more monetary stimulus, lower interest rates, quantitative easing, other programs that the Federal Reserve can initiate in order to keep liquidity flowing in the economy. So I don't think that's such a bad thing. But there are two hedge fund managers. I respect them greatly. One is David Tepper, and he is given a lot of credit for calling the Tepper rally shortly after the Great Recession ended and the Fed was about to initiate QE. He came out and said, buy everything, because the Fed's out there greasing the economy, and he was right. So one of the most extraordinarily successful hedge funds in the world, David Tepper, hedge fund manager, he says stocks are the most overvalued, or the second most overvalued he's seen since the year 2000. He said not everything is overvalued. He really pointed to some of the smaller NASDAQ companies. He said more stimulus could help with that, but that's pretty negative, and people take him very seriously. And then Stanley Druckenmiller, another very well-known, highly regarded hedge fund manager, a real math nuts and bolts, not a showy, flamboyant kind of fund manager. Those are the ones that we don't like. But he came out and said he also thinks stocks are very high, and he says the upside reward for the stock market is very low, but the downside is very high. So it's hard to fight, these opinions. And then, by the way, there are other people who've come out today, like Bill Miller from like Mason, who's got a great track record. He said that he doesn't think stocks are permanently down. He thinks stocks can go higher. So it's not just these few voices. So these are some of the things. So I'm going to show you a couple more things, and then we're going to move along. Give you a quick wrap up. This is not just to give you a market wrap, but I'm trying to add, perspective and really choosing my words very carefully. Here are some of the industrial stocks. Okay, these are some of the industrial stocks that I follow. All right, and industrial has just got crushed. I mean, Caterpillar was off a little bit, but let's go down the line. UPS, Johnson Controls down over 2%, Emerson down almost 3%, Boeing down almost 3%, and then you get down here to 3M down almost 4%, Korn Ferry down almost, that's a not quite an industrial company, but down over 4%, and the airline, Southwest down 4.9%, American Air down 5.5%. But the big thing here that I'm really looking at is GE hit a new year low today. It's a $5 and change stock now. And if it breaks 5, I don't see what could save it. But the stock hit a new year low of $5.48. That's incredible. And people keep saying, "Oh, it's GE, it's GE." GE is yesterday's news. You take a look at this one over here. Let's look at some of the bank stocks. JP Morgan down 3%, almost 3.5%. Morgan Stanley down almost 4%. Citi down over 4%. Travelers, Bank of America, Key Corp down over 5%. IAT is an exchange-traded fund of U.S. regional banks. Think of like U.S. Bancorp, PNC Financial, that's down over 5%. AIG, Wells Fargo down over 6%. U.S. Bancorp down almost 7%. This is as much as the averages were down today, I'm surprised that they weren't down more. Okay, could have been a lot worse. In fact, markets were down a little bit lower. About 40 minutes before the close. And let's take a look at our FANG plus M. That's Facebook down 2.3%. So these are the biggest stocks, okay, in the on the market. Facebook down 2.3%, Apple down a little bit. Amazon was barely up. Netflix had an okay day, but Google down almost 2%, Microsoft down 1.5%. The major companies where the market cap weighting really counts in the S&P 500, really, it's hard to fight the gravity of these stocks. When these stocks go down, they have a tendency to pull markets down even more. So it wasn't, without the help from these particular stocks. So these are the big cap stocks that everybody's relying on to keep lifting the market. So when these aren't working, it's really tough to escape the gravity of these companies. And lastly, let's just take a look at winners and losers in terms of sectors. Utilities were down, but it was still the best sector of the day. So pretty much everything down across the board. I'm not saying there weren't individual stocks that are up today, just as far as sectors go. Industrials, financials, and energy. Look, I've said this before, and if you've been watching this, industrials, financials, and energy, when it's a V-shaped day, when the market goes down and then the expectations is we come right back up, the economy goes right back up, that's a V-shape, right? And V-shaped recovery. And when industrials, financials, and energy lead the way, we get talk of a V-shaped recovery. And when they don't, we get talk of an L-shaped recovery, meaning just goes down and stays down for a long time. I wouldn't say today was even a U-shaped day. So that's really what we are looking at. And I'll just see if I could pull up this might, if this takes any more than like a second or two, I'm not going to keep it on the screen and keep you waiting. All right, came up pretty darn fast. Wow, things are working great today. Some of the COVID stocks, the coronavirus stocks, I call them, Zoom is up, Clorox is up, Activision Blizzard is up, J&J, well, it was off a penny a share. I mean, will you entertain the thought that maybe we could call that flat? It was down a penny. So you have the coronavirus stocks working up today, which means people are worried about the economy and a rebound. So let's get on to the next thing. Big worries that if the economy opens too soon, we get too much of a rebound in coronavirus COVID-19 cases. And people are worried about that. But we talked about that. We said Georgia was opening, and then Texas and a bunch of other states. Even New York is getting ready to start opening. So now we're at the, deep breath moment to see how things really, really go. So are we going to get a successful reopening? Will cities or towns or regions that have widespread cases of COVID-19, will they be able to clamp down and say everybody in that to everybody in that region, social distance, stay home, self-isolate, quarantine, etc.? We can't have that for the whole country. We can't have it. We have to get the economy open. I want it to be done measured and slow. That's why when New York closed and a lot of the states closed in March, around March 20th, my hope was that every state would close for like a good solid 2 or 3 weeks and really kick this thing. We didn't have that. It was just kind of done piecemeal around the country. But we have to get the economy rolling. I mean, could we wait? What if a vaccine doesn't come out for 3 years? No way. We can't wait. So it's going to have to be measured, careful, and we're going to learn a lot. And unfortunately, it's going to be a bumpy ride and probably filled with a lot of heartache. So that's the deal. You saw Dr. Fauci yesterday. He was pressed by Congress, interviewed, or put in the hot seat, whatever you want to call it. And, look, he's a doctor. I expect him to be very careful. I believe him. But it is what it is. We have to get the economy going and still be very careful. So let's see who's out there. Judy's out there. Love you too, sweetheart. I got a heart for my wife. And Bill is out there. Hey, Bill, how are you? Not a particularly good week so far. Yeah, you know what? It's not a particularly good week so far. And it's only Wednesday. So we have 2 more days to really make it a bad week. It's a pretty tough week. And Tom is out there. Good afternoon, Mitch. Good afternoon, Tom. Good to see you, buddy. And you swinging the sticks at all lately, Tom? Tom and I know each other through golf, through the gym, and just from constantly running into each other over like the last 15, 20 years. We've become good friends. It's just a nice way that happened. Okay, we've got a few people out there who are watching in Facebook land, and I appreciate all of you out there. Let's take a look to see who is out there in LinkedIn land. We've got a few people out there. I actually have a lot of financial advisors who watch me on my live stream, and I really appreciate that, guys. Hey, Christine's out there in LinkedIn land. So that is really, really cool. So I have a bunch of financial types who watch this. Well, the weather's getting nicer, and I have a feeling people are going to be less inclined to be in between 4:30 and 5 o'clock when the weather is nice. So finally, spring is starting to appear. So I want to thank all of you for watching tonight. If you have any questions and I missed them, hit me up in the comments. I'll get back to them. It was a rough day. It's the deep breath moment. You know, states are open, positive drug news on remdesivir, but now we have to see proof that this is going to work, that states can open, do it carefully, and then we're not going to get a flood of COVID cases. There are a lot of cases happening, popping up in the United States. But I guess, as long as it's spread out, not all in one region and crushes one hospital system like what happened in New York City, we will be much better off and much better able to handle it. There are so many things up in the air right now. It's really hard to give you just, I know you want just a direction of this is what's going to happen. This is when things are going to go up. I wish I could give you that. I don't think anybody can. I really just want to give you perspective to help you think for yourself. Over the next few days, we're going to be talking about some credit card stuff, some financial scams that are going on, and some other things that are a little bit more in the personal finance realm. All right. I'll see you tomorrow. Thanks for watching.